Hello, friends. Banks can restrict access to your savings after 65 without warning. And right now, under rules already on the books, they are doing it. If you are 65 or older, or you help a parent over 65 move money, pay bills, or manage a bank account, this is for you. In one recent one-year stretch, banks filed more than 155,000 elder financial exploitation-related reports, tied to more than $27 billion in suspicious activity. And here is what almost nobody understands. If the bank files one of those reports on your account, it generally cannot tell you it did. Not before, not after. The rules are not new. The problem is that almost no one knows they exist until the money stops moving. Hello, friends. This is not a scam story. The rules I'm about to walk you through apply to completely legitimate transactions. Money you earned, money you deposited, money you need to pay a bill or a contractor or a family member. And the part that should stop you cold is this. The bank is not required to explain everything it is doing, or why, before the money stops moving. Grab a pen. I want you to mark the places where your own banking life looks nothing like your usual pattern, because at least one of these applies to more people than they think. This is about rules and response, not panic. Subscribe now, because these bank rules, complaint channels, and state hold laws are the kind of fine print nobody reads until the money stops moving. I track them before that happens, and the people subscribed here find out in time. Subscribe now and let's get into it. Before we go further, I need to address something, because people hear a topic like this and immediately sort themselves into one of two groups. The first group is the comfortable retiree, some savings, maybe a paid-off home, and they figure this is about scam victims or people in worse shape. The second group is living on a fixed income, and they've learned the hard way that the system rarely works in their favor. Both of those assumptions are wrong about at least one of the items I'm covering today. And on every single one, I'll tell you exactly which group it helps most and how. Here's what I'm going to cover. I'll tell you what the bank can do without telling you. I'll show you the specific patterns that trip the wires on a perfectly innocent transaction. I'll explain why proving you're innocent is not the same thing as proving the bank can verify it fast. I'll walk you through the paperwork trap that can lock your own family out of your accounts overnight. And then the last part. Stay with me, because the last part is the one most people never use. The exact complaint path and the exact words that can force a written response instead of silence. Let's start. Number 1. What the bank can do without warning. Most people assume that if the money is theirs, the bank has to explain everything before it restricts anything. That assumption is wrong, and it is wrong because of a rule most people have never heard of. There is something called a SAR, a Suspicious Activity Report. In plain English, it is a report the bank files with the federal government when it spots activity that looks unusual. Here is the part that matters to you. If the bank files one of these reports, it generally cannot tell you that it filed it. That is not a bank policy. That is federal law. The bank cannot disclose the existence of the report to the person the report is about. Now, a SAR does not automatically mean your account is frozen. Those are two different things. But they can overlap, and when they do, you are dealing with a restriction you cannot see and a report nobody is allowed to explain to you. Here's the scale. In one recent one-year stretch, June 2022 to June 2023, banks filed 155,415 elder financial exploitation-related reports, tied to more than $27 billion in suspicious activity. More than $27 billion in 1 year is why the bank's monitoring is not casual. The filing clock works like this. Once a bank detects facts that may require a SAR, it has 30 calendar days to file. If it cannot identify a suspect, it may take another 30, but never more than 60 calendar days total. During that window, if a separate restriction is placed on the account, you may not know the full reason. This helps both groups, the comfortable retiree and the fixed income retiree, because the core issue is not how much money you have. It is how the bank's reporting and confidentiality rules work. Your balance does not exempt you. Here is what to do. Contact the bank's fraud or security department. Not just a teller, not just the general line. Use the exact words. I am the account holder. This transaction is legitimate. Tell me exactly what documents you need, which department is reviewing the restriction, and how I can send those documents today. Write that down. There is no universal consumer deadline that forces the bank to tell you more, and there is no appeal form for ASAR. But you can demand clarity on what they need from you, and you can deliver it fast. That is number 1. That is the rule book. Now let me show you how a completely ordinary retirement transaction can trip those wires anyway. Number 2, the legitimate transaction that trips the wires. Here is the misconception. Most people believe only obvious scam victims get flagged. People who got tricked. People who wired money overseas. That is not how the monitoring works. The government publishes a list of red flags that banks are trained to watch for. These come from a FinCEN advisory, that is, the Financial Crimes Enforcement Network, the federal agency that oversees this reporting. And the advisory defines older adult as 60 or older, not 65. So the monitoring window is wider than most people realize. Here are some of the patterns the bank is watching for. A new caretaker, relative, or friend suddenly making transactions without proper documentation. Sudden changes in a power of attorney, a trust, or estate planning documents. Uncharacteristic, sudden, frequent, or significant withdrawals. Transfers to unfamiliar recipients. Frequent large withdrawals, including daily maximum ATM withdrawals. And an older customer who appears to be taking instructions from someone else during the transaction. No single red flag is proof of wrongdoing. The advisory says that clearly. But when multiple flags stack at the same time, the bank's system escalates. Here is where this helps the comfortable group more than they expect. If you are a comfortable retiree who rarely moves large amounts, then the one time you do, a car sale, a home repair, a family gift, it looks abnormal precisely because it is unusual for you. A viewer wrote to me about a situation like this. Linda, 73, a retired school secretary outside Tampa, Florida. She sold an SUV for $24,000, deposited the money, and then tried to send $18,600 to a roofing contractor. Her son went to the branch to help, but the bank had no power of attorney on file for him. In the bank's eyes, that stacked multiple red flags at once. A large out-of-pattern deposit, a rapid large payment to a new payee, and a third party speaking for the account holder without formal authority. The fix. Linda went back to the branch herself, with her ID, the roofing contract, the invoice, and a durable financial power of attorney to place on file for her son. She asked for the exact department reviewing the restriction and the exact document list needed to clear the payment. The amount at stake, $18,600. The math is simple. $24,000 deposit minus $18,600 contractor payment equals $5,400 remaining. The money was real. The roof was real. The problem was documentation, not fraud. The bank does not place your documentation on file automatically. Nobody prepares that paperwork for you. If you have a helper, a son, a daughter, a neighbor, and they do not have documented authority, the bank is trained to treat that as a warning sign, not a convenience. Before any large or unusual transaction, keep the invoice, the contract, the bill of sale, and your ID ready. Do not let a helper act alone at the branch unless authority is already on file. Say this: here is the contract, here is the payee, and here is why this transfer is different from my usual activity. That is number 2. And here is the part most people still miss. The problem is not always fraud. Sometimes the problem is verification. Number 3. Innocence is not the test. Verifiability is. I need you to hear this one carefully because this changes the picture. Up to this point, everything I've covered sounds like the bank is looking for criminals. And sometimes it is. But sometimes the bank is not waiting to decide whether you are guilty. It is deciding whether it can legally let the money move. In some states, banks can temporarily hold a transaction or delay a disbursement when they suspect elder exploitation. This is not one nationwide law. It varies by state, and many states do not have these hold laws at all. But in the states that do, a trained bank employee can pause a transaction, and the Senior Safe Act, a federal law that defines senior citizen as not younger than 65 years of age, gives those trained employees legal protection for reporting suspected exploitation in good faith. Here is the misconception this shatters. Most people think that if they explain the transaction once, that should end it. But if a state hold law applies, the bank may have a legal basis to delay the disbursement regardless of your explanation, at least temporarily, while it verifies. This is not a monthly fee problem. It is a full one-time access problem. A legitimate one-time transfer is still a full one-time problem if the bank cannot verify it when the money is needed. Now, here is the part that surprises the fixed income viewer. The same machinery that feels threatening can sometimes work in your favor. If someone is exploiting an older person's account, draining it with unauthorized transfers, these hold tools can stop the money before it disappears. Timely reporting increases the likelihood of successful recovery. So the system is not purely an obstacle. It is a gate that swings both ways. The question is whether you are on the right side of it with the right paperwork. Here is the action. Put a durable financial power of attorney on file with your bank before there is a crisis. Not during the crisis, before. And if your institution offers a trusted contact designation for deposit accounts, add that too. Use these words: I want this durable financial power of attorney reviewed and placed on file before there is an emergency. If your bank offers a trusted contact for deposit accounts, I want to add that too. Nobody files that paperwork for you. The bank does not remind you. The protection only exists if you set it up in advance. That is number 3. But the paperwork trap is even worse, because there is one moment when your helper's authority can disappear instantly. Number 4. The paperwork trap after incapacity or death. Here is the belief that costs families the most time and the most money. My daughter can handle that later. Or, I already have a power of attorney, so she's covered no matter what. Both of those assumptions can fall apart in a single afternoon. Let's start with the power of attorney. A valid state law POA generally should be accepted by the bank. But banks can refuse it in certain situations. If they suspect forgery, if they believe it has been revoked, or if they suspect exploitation. The Consumer Financial Protection Bureau, the CFPB, recommends sharing a POA with the bank in advance, not showing up with it for the first time during a crisis. If the bank has never seen the document and the account holder is suddenly incapacitated, you are asking a compliance officer to trust a piece of paper they cannot verify with the person who signed it. Now here is the part most people do not know. A power of attorney generally expires at death. The moment the account holder dies, the POA your daughter has been using to pay bills and manage transfers is no longer valid. She does not get a grace period. The authority ends. So what happens next? That depends entirely on whether the account has a payable on death or transfer on death designation, a POD or TOD. In plain English, that is a line in the bank's records that says, when this account holder dies, pay the balance directly to this named person. If the beneficiary is named in the bank's records, the transfer can happen relatively quickly. If no beneficiary is named, the account may sit in limbo until probate sorts it out. Here is where the comfortable retiree gets hit hardest by not knowing. If you have larger balances spread across sole name accounts with no POD designation, every one of those accounts becomes a bottleneck the moment something happens to you. The FDIC insurance math matters here too. For trust and POD accounts, the coverage formula is the number of owners times the number of beneficiaries times $250,000, up to $1,250,000 per owner with 5 or more beneficiaries. One owner with 2 named beneficiaries can sit in a $500,000 insured category. One owner with 4 named beneficiaries reaches $1 million. 5 or more beneficiaries caps at $1,250,000 per owner. If the beneficiaries are not specifically named in the bank's records, that coverage calculation does not apply the way you expect. The beneficiary does not appear in the bank's records unless you put one there. The bank does not ask you about it at account opening unless you raise it. And the POA does not survive the one event, death, that makes a smooth transfer matter most. Here is the action step. Review every sole name checking, savings, and CD account. Ask the bank to confirm whether each account has a payable on death or transfer on death beneficiary on file, and ask exactly how that beneficiary is listed. Use these words. Please confirm whether this account has a payable on death or transfer on death beneficiary in your records, and tell me exactly how that beneficiary is listed. Do not assume your daughter or your son can handle it later. The time to verify this is before the paperwork matters, not after. That is number 4. So what do you do when the money is yours, the transaction is real, and the bank still will not move? Here is the framework. Number 5. What to do immediately when access is restricted. Here is the last misconception, and it is the most expensive one. All I can do is wait. You do not have to wait in silence. There are specific complaint paths, and some of them come with a response clock. The first path is the CFPB, the Consumer Financial Protection Bureau. Their complaint portal covers checking and savings accounts, and you can reach it at consumerfinance.gov/complaint or by phone at 855-411-2372. When you file a complaint through the CFPB, the company generally responds within 15 days. In some cases, a final response may take up to 60 days. A 15-day response clock is not instant, but it is better than silent drift. The second path is the OCC, the Office of the Comptroller of the Currency. In plain English, this is the federal regulator for national banks and federal savings associations. If your bank falls under OCC oversight, you can call their customer assistance line at 1-800-613-6743. One important note, the OCC only handles complaints about the institutions it regulates. If your bank is state chartered or a credit union, you may be routed to a different regulator. The third path is for situations where actual exploitation is suspected. Not just a delayed transaction, but real financial abuse. The Elder Care Locator connects you to your local adult protective services at 1-800-677-1116. And the Department of Justice runs the National Elder Fraud Hotline at 1-8333-728311. Here is who this helps most: the fixed income retiree, because these channels are free. You do not need a lawyer to file a CFPB complaint. You do not need to pay anyone to call the OCC. But the framework works for both groups because the principle is the same. A written complaint with documentation attached is stronger than a phone conversation nobody recorded. Here is the action. If the bank is not resolving your access issue, complain in writing. Attach your statements, the bank's messages, and the documents proving the transaction was legitimate. Use these words: I am submitting a complaint about restricted access to my deposit account. I contacted the bank first, and I am attaching my statements, the bank's messages, and the documents proving the transaction was legitimate. The complaint does not write itself. The recovery call does not happen unless you make it. But a 15-day response clock on a formal complaint is better than waiting by the phone, hoping someone at the branch calls you back. That is number 5. So here is the full picture. The first thing is the no warning rule. The bank can restrict access under rules it does not have to narrate to you in full. And if a suspicious activity report is involved, it generally cannot tell you it exists. The second is the trigger stack. A large out-of-pattern transaction, a new payee, or a helper without documented authority can make a perfectly legitimate move look wrong. The third is the reframe. Innocence is not the test. Fast verification is. The fourth is the paperwork trap. A power of attorney expires at death, and a missing POD designation can turn your own family into outsiders overnight. And the fifth is the response path. Document it, escalate it, complain in writing, and report real exploitation beyond the bank. 5 rules, 5 action steps. Every one of them requires you to move first. The bank does not place your power of attorney on file automatically. The beneficiary does not appear in the bank's records unless you name one. The bank does not have to tell you a SAR was filed. The complaint does not write itself. The recovery call does not happen unless you make it. Owning the money and being able to reach the money are 2 different things. The gap between them is documentation, timing, and information. I want you to think about one person right now: a parent, a widow, a neighbor, a friend from church over 65 who lets an adult child help with bills, or who only moves money in big chunks a few times a year. Share this with that person. Not because they are careless, because the exact people who get hit by these rules are often the people doing something perfectly reasonable at exactly the wrong moment, without the paperwork already on file. Subscribe, share this with someone you know who helps an older parent manage a bank account, and I'll see you in the next one.